Welcome back to Global Macro Pulse. For today's deep dive, we are unpacking a really terrifying, but frankly fascinating paradigm shift that's unfolding right on the desk this morning.
Yeah, terrifying is definitely the word if you're caught offside today.
Exactly. We're witnessing this massive systemic divergence right across the global board. It's a deep fracture between, well, skyrocketing energy markets on one side and a U.S. labor market that is just beginning to collapse under its own weight on the other.
The cross currents are insane right now.
They really are. This is the kind of macroeconomic setup that just breaks traditional models. So our mission today for our listeners is to figure out exactly what this means for institutional capital. We need to unpack this textbook stagflationary setup, look at the geopolitical risk premium, and basically examine how smart money is positioning for a fractured global supply chain.
Right, and looking at the terminal price action crossing the desk right now, the hard data is absolutely brutal. WTI crude, the U.S. oil benchmark, it just gapped up 20% right at the Monday open.
20%, yeah.
Completely blew past key resistance levels. It crossed $110 a barrel. Brent crude, the global benchmark, has simultaneously cleared $100, and this explosion in energy pricing is colliding directly with Friday's non-farm payrolls print, which, by any quantitative measure, was a complete disaster.
Yeah.
The volume divergence we are seeing across asset classes is just extreme.
If investors are looking at their portfolios right now, they're probably wondering how to hedge this.
Yeah.
And to understand that, we have to start with the engine driving this entire tape, which is the geopolitical landscape in the Middle East.
Flashing completely red.
Exactly. According to the strategic analytics we're tracking, there's a major leadership transition underway in Iran, moving toward Khamenei-san Mojtaba. Now, looking at the reaction out of Washington, D.C., operating on Eastern Time, the administration is reportedly refusing to accept this transition.
Which is a massive wild card.
It is. And keep in mind, we are strictly analyzing these developments neutrally. We aren't taking any political sides here, but we are tracking explicit rhetoric about, completely clearing out the current leadership, alongside statements that military budgets could be hiked to $1.5 trillion.
The politics are noise, though. I mean, the raw volume and physical supply metrics are what actually matter to the tape, and they are breaking down.
Break it down for us.
Let's look at the physical flow on the ground. Just as markets opened in Baghdad this morning, local time, we tracked Iraqi oil production cratering from 4.3 million barrels per day down to just 1.3 million.
That's 3 million barrels.
3 million barrels of daily supply effectively wiped off the global order book in a matter of days. To put that in plain English for our listeners, imagine trying to run a global factory and suddenly 70% of your fuel shipments just don't show up.
It's a localized heart attack for the grid.
Exactly, and simultaneously, looking at the data out of the Gulf, storage facilities across the UAE and Saudi Arabia are either at absolute maximum capacity or they are actively under drone attack. Kuwait is already executing preventative production cuts. The physical buffer in the system is entirely gone.
Which brings us to the ultimate maritime choke point, the Strait of Hormuz. We're seeing real-time reports of an Iranian drone strike hitting the USS Lincoln.
Right, and the market reaction to that was immediate.
It had to be. In response to this deteriorating security environment, Washington has offered naval escorts for commercial vessels and insurance backstops. But the Iranian Revolutionary Guard has effectively stated they control the strait, and they are banning U.S. and allied vessels from passing through entirely.
Completely severing the artery.
Exactly. We're talking about the primary artery for global hydrocarbons being actively severed. We are moving from an era of free navigation to an era of militarized logistics.
Yeah, and if you look at the derivatives market, the options chain is in pure panic mode. The volatility skew in oil options is as extreme as I've ever seen it.
Explain that skew for the listeners.
Sure. Volatility skew essentially measures how desperate traders are to protect themselves against extreme price moves. Right now, traders are aggressively bidding up right tail risk. That means they are paying massive premiums for options that only pay out if oil prices go stratospheric.
So they're pricing in a catastrophic spike.
Exactly. It's like buying fire insurance when the house next door is already in flames. Furthermore, there is serious terminal chatter that Washington is considering targeting Iran's Karg Island.
Oh, wow. Karg Island. That handles, what, almost all their exports?
90%. Karg Island handles roughly 90% of Iranian crude exports. But I have to play devil's advocate here for a second. We see traders panic over headlines all the time. Isn't a $110 oil spike just a temporary shock? Why should investors believe this is a permanent structural shift and not just a knee-jerk reaction we should be fading?
That is the trillion-dollar question. But I would argue it absolutely is a structural paradigm shift in energy security. When you start discussing the targeting of terminal infrastructure that handles 90% of a sovereign nation's exports, you are permanently altering the physical supply chain.
Because you can't just rebuild a terminal overnight.
Exactly. That kind of infrastructure takes years to rebuild, assuming the conflict even allows for reconstruction.
Okay.
We are moving from a world of just-in-time globalized energy delivery to a highly fragmented, just-in-case energy hoarding model.
Right.
Sourcing reliable energy is no longer just about market economics. It's a matter of strict national security.
And that energy hoarding is colliding directly with the domestic macro data, which brings us to Friday's shock.
The payrolls print.
Yeah. At exactly 8:30 a.m. Eastern Time on Friday, the Bureau of Labor Statistics delivered a massive blow to the whole soft landing narrative. For investors tracking the labor market, the non-farm payrolls report is essentially the ultimate report card for U.S. job creation.
And it was a failing grade.
A total miss. The headline number was a net loss of 9.2 thousand jobs against expectations of a 60,000 gain. But the real institutional horror wasn't the headline, it was the revisions.
The revisions were staggering.
The previous 2 months were revised down by a combined 69,000 jobs. Algorithmic trading models price in the headline, sure, but institutional money managers look at the revisions to see the actual trend line. And the trend is highly toxic.
Unemployment ticked up, right?
Ticked up to 4.4%. The labor market is contracting significantly faster than anyone predicted.
Looking at these labor numbers compared to oil prices pushing $110, I feel like I'm watching a slow-motion car crash.
Yeah.
But the car is carrying everyday investors' retirement accounts.
It's a brutal wealth destruction event.
This is where the concept of systemic risk becomes very real. You have to connect that labor contraction directly to the oil price explosion we just debated. This is a classic, unavoidable macro headwind. With WTI up here, you are going to see a massive secondary wave of consumer price increases.
Which totally traps the Fed.
The Federal Reserve is trapped in a burning building. They are in a liquidity cycle of their own making. They can either put out the fire of inflation by keeping interest rates high,
Which destroys even more jobs.
right, or they can try to save the jobs by cutting rates, which just lets inflation burn completely out of control.
The yield curve is reflecting that exact paralysis today. Right now, the 10-year Treasury is sitting at 4.146%, and the 2-year is at 3.558%.
It's completely distorted.
It is. For our listeners, the yield curve is just the difference in interest rates between short-term and long-term government bonds. Usually, you get paid a higher rate to lock your money up for 10 years than 2 years. When the gap narrows or acts strangely like this, it means the bond market is extremely anxious about the central bank's next move.
They don't know if the Fed will hike, cut, or pause.
Exactly. Right after that jobs print hit the wire, Fed Fund futures actually briefly priced in a 50% probability of a June rate cut. But the hard data won't allow it.
No, absolutely not.
We just heard from Cleveland Fed President Hammack explicitly stating that rates will likely remain unchanged for a prolonged period. The inflation data driven by this oil spike simply takes the punch bowl away, no matter how ugly the employment numbers get.
It is a textbook liquidity trap. The central bank is utterly paralyzed. If they cut rates to support the collapsing labor market, they risk unanchoring inflation expectations completely, especially with energy input costs exploding for producers.
Margins would get crushed.
Exactly. If they hold rates high, they accelerate the destruction of corporate margins anyway. Investors listening need to understand that this is the literal definition of stagflation. Stagnant economic growth paired with structural, supply-driven inflation.
Let's look at how institutional capital is attempting to hide from this stagflationary reality, because the price action in precious metals has been historically anomalous over the last few days.
The gold chart is wild right now.
It's unprecedented. Midweek, spot gold suffered a violently aggressive $300 flush, dropping all the way down to $5,088 per ounce. The sheer velocity of that drop was terrifying. It actually triggered the CME, the Commodities Exchange, to step in and lower margin requirements for gold and silver futures.
Which is incredibly rare.
Extremely rare. To put that in plain English, the price dropped so fast that the exchange bent its own rules to make it cheaper to trade, just to prevent a total market freeze or a liquidity cascade. Usually, when volatility spikes, exchanges raise margin requirements to protect themselves. Lowering them is an emergency level move.
just to keep the plumbing working.
Exactly. Yet, despite that brutal flush, the buyers stepped right back in and gold rallied to close the week at $5,174.
You cannot look at that specific volatility without applying the lens of fiscal dominance. We are seeing a complete divergence in how sovereign actors are behaving under stress.
It's a split market.
Completely. On one hand, out of Warsaw, operating on Central European time, the reports indicate Poland's central bank is actually considering selling some of its gold reserves specifically to fund national defense initiatives.
Liquidating for military capital.
Right. But on the other side of the globe, by the time traders in Beijing sat down at their desks, the People's Bank of China officially added to its gold reserves for the 16th consecutive month.
The 16th month, that's a structural bid.
It is a profound philosophical split. Western central banks are starting to view gold as a liquid asset to fund immediate military operations, while Eastern central banks view it as a foundational physical reserve to insulate their economies against the U.S. dollar.
The divergence between the physical and paper markets is where the real actionable data is right now. There is a fascinating arbitrage metric flashing on the terminal today.
What are you seeing?
If you look at pricing localized to Gulf Standard Time in Dubai, the physical gold market is currently offering a $30 per ounce discount compared to the London Global Benchmark.
Wait, a $30 spread on physical versus paper?
Yes. For a globally fungible asset, meaning an ounce of gold is exactly the same no matter where it is, that spread is massive. Normally, high-frequency traders would instantly buy the cheaper gold in Dubai and sell the expensive contract in London to pocket the difference, closing that price gap in milliseconds.
So the fact that it's staying open,
The fact that this $30 gap isn't closing is a huge red flag.
it fundamentally proves a decoupling of Western paper markets and Eastern physical demand. The East is accumulating physical bullion, while the West is trading synthetic derivatives.
The trust is gone.
That's exactly it. When you see physical markets diverging so sharply from the paper benchmark, it tells you that trust in the institutional clearinghouses is eroding. Sovereigns want the actual metal securely stored in their own physical vaults, not a paper claim on metal sitting in a vault somewhere in London.
Right.
That lack of trust is a symptom of a much wider systemic fracture.
And that fracturing of trust extends directly into global equities and trade pathways. Looking at the geopolitical desk out of Washington, D.C., Treasury Secretary Besson is expected to implement the new 15% tariff this week.
A massive headwind for global trade.
But here's the kicker. Out of Brussels on Central European time, reports indicate the EU secured an exemption from these tariffs. It's a targeted weaponization of global trade flows.
And it is not just basic goods, it is the absolute bleeding edge of technology. The U.S. is now pushing legislation to extend AI chip export controls globally.
Which is choking the semiconductor space.
Exactly. This will require specific, highly restrictive export licenses for companies like NVIDIA and AMD. And the market impact was immediate. Intel dropped 5% almost instantly, and major semiconductor names are bleeding across the board.
They're losing their global customer base.
The market is aggressively pricing in the permanent loss of global revenue streams for U.S. hardware champions.
Well, Asia is immediately responding to this hardware chokehold. Out of Tokyo, Japanese local time, the government announced a massive initiative aiming to generate $254 billion in domestic semiconductor sales by 2040.
$254 billion. That's state-sponsored capitalization.
They are rebuilding their sovereign tech stack from the ground up. Meanwhile, over in China, as the National People's Congress opened this afternoon Beijing local time, the government officially set a 2026 GDP growth target of 4.5% to 5%.
Which requires massive stimulus to hit.
Right. They are forecasting an economic increment of over 6 trillion yuan. And to guarantee that liquidity flows exactly where they want it, the PBOC is floating a new national-level M&A fund to consolidate and strengthen their domestic industries against these U.S. tariffs.
So they're building an impenetrable domestic fortress.
The pure data suggests a ruthless rotation is underway. The trade being telegraphed here by institutional capital is to move money out of over-regulated, export-restricted U.S. tech and allocate it directly into these heavily subsidized domestic Asian growth stories.
Follow the liquidity.
You always follow the sovereign liquidity. If the PBOC and the Japanese government are backstopping their domestic semiconductor markets to the tune of hundreds of billions of dollars, that is where the volume is going to flow.
But let's debate the longer-term consequence of that capital flow. Is this merely a short-term cyclical rotation, or is this the actual end of globalized free trade?
It looks pretty permanent from the data.
I would agree. Because when you see a state-sponsored put option placed under Japanese and Chinese domestic tech, while the U.S. actively restricts its own export markets, I would argue you are witnessing the permanent bifurcation of the global economy.
Two separate systems.
You are going to have a U.S.-centric technology stack and an Asian-centric technology stack, and they simply will not interface with one another.
So if we pull all of these threads together, what does this actually mean for investors listening right now who are just trying to manage their exposure?
It means we are operating in an era of systemic supply shocks. The inflation we are seeing right now is incredibly sticky because it is driven by physical constraints. War, tariffs, disrupted shipping lanes in the Strait of Hormuz, not just monetary policy.
It's physical, not paper.
Exactly. And in this specific macro environment, the traditional 60-40 portfolio is fundamentally dead.
Dead and buried.
Traditionally, you hold 60% stocks for growth and 40% bonds for safety. The idea was that if stocks drop, bond prices usually rise as investors seek a safe haven. But when inflation is driven by physical constraints like a $110 oil shock, raising interest rates doesn't pump more oil or build more ships.
No, it just crushes growth.
Bond yields surge and bond prices crash right alongside your equities. Holding 40% in bonds cannot protect you when both sides of the portfolio are burning. There's nowhere to hide in paper.
Exactly, which is why the technical roadmap requires a completely different approach today. Investors need to pull up the 200-day moving average on their energy equities immediately.
A crucial indicator right now.
For those unfamiliar, the 200-day moving average is simply the average price of an asset over the last 200 trading days. It smooths out the daily noise to show you the true long-term trend. That is your primary gauge for trend continuation right now.
So if it holds above that line,
if energy equities break and hold above that 200-day moving average on high volume, the stagflation trade is fully confirmed and you must allocate accordingly. Furthermore, with central banks aggressively hoarding physical assets while global energy routes are actively militarized, investors must ruthlessly evaluate their hedging strategies.
it comes back to physical realities.
You need to heavily consider physical commodity exposure over synthetic derivatives. A paper futures contract will not power a factory, and it won't protect your portfolio if the physical supply chain completely breaks down.
I want to leave investors with a profound structural question to mull over as they manage risk this week. With AI compute being actively weaponized via these new global export controls and the U.S. dollar's petrodollar dominance facing its biggest physical militarized challenge in the Strait of Hormuz, are we watching the real-time unwinding of a unipolar financial system?
That is the ultimate systemic question. And looking at the divergence in the data crossing the desk today, the answer might just be yes.
Fascinating stuff today. Stay ahead of the curve. This is Global Macro Pulse.
Disclaimer, not financial advice.